Good evening to all of you. Welcome to Amigos IAS Academy. And I also welcome all of you for this Edu Talks, which we are conducting on every Saturday. Okay? So today we have invited Professor Koti Reddy garu, Professor Tamma Koti Reddy garu, who is a senior professor and dean at ICFI University. You know, ICFI University is one of the most prominent university, popular for management sciences, social sciences, and engineering courses. Okay. So today, Professor Koti Reddy garu is going to deliver a lecture on the monetary policy framework in India, which is very much relevant to UPSC prelims as well as mains examination. So before his presentation, let me briefly introduce about Professor Tamma Koti Reddy garu. As I said, Professor Tamma Koti Reddy is a professor and dean at ICFI School of Social Sciences, ICFI University, Hyderabad. He is well known among the academic circles as a subject expert on Indian polity, economics, and international finance. He has published more than 80 research articles in national and international journals of repute in the area of development economics. Professor Koti Reddy was awarded the IBSAF Best Teacher Award in 2013 and the NJ Yasasvi Apollo Hospital's Best Teacher Award in 2016-17. He has chaired several international conferences and delivered keynote speeches on policies and issues pertaining to economics. He is the editor-in-chief of the IUP Journal of Applied Economics. And one of the most important contribution of Professor Koti Reddy garu is that he has published more than 600 articles in Telugu newspapers like Eenadu, Sakshi. He has published number of articles on the issues related to Indian economy. And he has immensely contributed to the academics, especially in the field of economics. And in fact, around 2008 and 11, prior to that, he used to take classes even for the students preparing for civil services examination. He used to teach economics for the civil services aspirants. But since he is busy at ICFI University now, he is not able to take the classes. But on my request, he has expressed his willingness to deliver a lecture on monetary policy framework of India. So this is about Professor Koti Reddy garu. On behalf of Amigos IAS Academy and on behalf of all of you, I invite Professor Tamma Koti Reddy garu to come over to the dais and deliver his lecture. Thank you, sir. Welcome.
slides ఎట్లా Next slide is the. Good evening to you all. I thank Professor Ganesh Garu for introducing me. My topic for today's presentation is monetary policy framework in India, which is very much useful for both the civil service and group 1 students. And you can also expect some questions as part of MCQ, and at the same time even as essay question also related to monetary policy framework. As far as the monetary policy framework in India is concerned, before that you should have some idea about macroeconomic policies in India. Macroeconomic policy refer to strategies and actions adopted by the government and central banks. Government and central banks will adopt macroeconomic policies to influence the overall economic performance of the country, aiming at achieving higher economic growth, low unemployment, price stability, and equilibrium in the balance of payment. So these are the objectives of macroeconomic policies. For example, achieving economic growth, price stability, full employment, and at the same time achieving disequilibrium in the balance of payment. Once you observe these objectives, you will find there was some complexity between the macroeconomic objectives. There was a trade-off between economic growth and inflation. For example, to accelerate economic growth, if we enhance money supply in the country, it would lead to inflationary pressures. So there was a trade-off between economic growth and inflation, and there was also a trade-off between employment and inflation, unemployment and inflation, and trade-off between balance of payment and domestic economic objectives. So there was a trade-off between these economic objectives, macroeconomic objectives. So in view of the conflicts between macroeconomic objectives, it is said the main objective of the macroeconomic policy is achieving economic growth with a reasonable price stability. Because just now I have mentioned the conflicts between the macroeconomic objectives. So as a result, just at the I told the here the macroeconomic objective, as far as the macroeconomic objective is concerned, we focus on economic growth, achieving economic growth with reasonable price stability. The next one, these are the various macroeconomic policies: monetary policy, fiscal policy, exchange rate policy, and income policy. Monetary policy is a macroeconomic tool adopted by Reserve Bank of India to influence money supply in the country. So the Reserve Bank of India regulate money supply in the country. For example, whenever money supply rises, people will have excess money in their hands. Whenever people have excess money in their hands, they demand for more goods and services. Thereby aggregate demand would rise. Rise in aggregate demand would contribute for rise in price level, inflation. So as because of inflation, some section of the people will get affected adversely. At the same time, whenever money supply falls, the purchasing power of the people will be low. They cannot demand for more goods and services. Thereby aggregate demand will be low. Whenever aggregate demand falls, the production will be low, investments will be low, production also will be low, employment opportunities will be low, income of the people will be low, purchasing power also will come down, and lower purchasing power would contribute for low aggregate demand. So such things would contribute for slow growth in the economy. If slow growth continues for a long time, economy would get into recession. So as a result, it is the responsibility of the Reserve Bank of India to regulate money supply in the country. So to regulate money supply in the country, Reserve Bank of India employs various policy instruments. The policy instruments are bank rate, open market operations, cash reserve ratio, repo rate, statutory liquidity ratio, and a reverse repo rate, marginal standing facility. These are the various instruments employed by Reserve Bank of India in regulating the money supply. The next one, fiscal policy. Fiscal policy is a policy adopted by government with regard to taxation, public expenditure, public debt, and deficit financing. Just I repeat again, fiscal policy is a policy adopted by government in relation to taxation, public expenditure, public debt, and deficit financing. Third one, exchange rate policy. Here, there is a need to choose an appropriate exchange rate system and determine the currency value. So we have to choose an appropriate exchange rate system. For example, if it from 1940s to 1971, fixed exchange rate system was in existence. Later, flexible exchange rate system came into existence across the world. Countries under IMF followed fixed exchange rate system till 1971. The fixed exchange rate system was put to rest by IMF in 1971, 72 during that time. Later, floating exchange rate system came into existence. So, we have to choose an appropriate exchange rate system and determining the currency value to take the all kinds of foreign transactions at that rate. So at that rate, all kinds of transactions takes place. As far as India is concerned, from 1947 to 1971, we have followed fixed exchange rate system. For example, India's currency value was pegged with a selected currencies across the world, fixed exchange rate system. Next one, and in between you will find gold standards, different kinds of systems you will observe. But whatever it may be, as a whole we can say fixed exchange rate system. From 1971 to 1975, India's currency value was fixed with pound sterling. From 1975 to 1992, India's currency value was pegged. Pegged is nothing but fixed with a basket of currencies. From 1992 to 93, we have followed dual exchange rate system. In most of the examinations, you might have observed this concept, dual exchange rate system. Dual, two types of exchange rate systems. On one hand, market rate of exchange. On the other hand, fixed rate system. Two kinds of systems. 92 to 93. Since 1993, Indian economy is following flexible exchange rate system. Flexible. Under flexible exchange rate system, the currency value will be determined by market forces, demand and supply. For example, how the prices of vegetables will be determined in the market. If you go to any Raitu Bazaar, just there you will find the prices of various vegetables. How the price will be determined, demand and supply. So if there is more demand for vegetables on any particular day, on the same day you will observe higher price for vegetables. If the demand rises, prices also rises. At the same time, if you demand for more foreign currency, you are demanding more. Why you are demanding more? Because you have imported larger quantity of goods. Thereby you have to make payments for importers in terms of their currency. If you import one product from Japan, you have to make payment in the form of yen only, their currency yen, or otherwise universally acceptable currency, American dollar. So, in order to make payment in terms of foreign currency, you demand for more foreign currency. If you demand for more foreign currency, the price of foreign currency would rise. Your currency value depreciates. So, this kind of system is in existence in India. Within that also, under flexible exchange rate system, you will find managed floating system, which is more important for competitive exams. Managed. So managed floating system is nothing but flexible or floating, both are same. Within the flexible exchange rate system, you will find managed floating system. Managed means the Reserve Bank of India will intervene in the forex market to address excessive fluctuations in the currency value, excessive fluctuation. So the Reserve Bank, not only Reserve Bank of India, in every country you will find their own central bank. Central banks will intervene in the forex market and adjust the peg by a smaller amounts to address the further fluctuations. For that, the Reserve Bank of India follows sterilization measure. Already it was given in civil service in the prelims exam, sterilization measure. Because Reserve Bank of India will maintain some amount of foreign currency at its disposal, Whenever is market experiences scarcity, it brings foreign currency to the market. Whenever there was excess of foreign currency available in the market, it will take the foreign currency from the market. So it will try to avoid further appreciation and further depreciation of the currencies. It will try to avoid further fluctuations in the currency value. This is about exchange rate system. As far as the income policy is concerned, so it is a policy related to wages. So government control of wages. Controlling of wages has become necessary nowadays. So controlling of wages has become necessary to avoid excessive demand for products, excessive demand. So as a result, government is required to formulate a rational income policy. See, for example, if wages are high, you are paying more wages to the workers. Not only to the workers, all classes of people. At higher wages, if the productivity is more, productivity means you know that. If a factory worker works on machine and produces 10 units, 8 hours you are working, you are producing 10 units of the particular product. That is productivity. So at a higher wage, if the productivity is more, you can pay more wages to the laborers. But without improvement in productivity is not improving, but you are paying higher wages. It would contribute for excess demand and inflationary pressures. So as a result, it is the responsibility of the Government of India to formulate an appropriate income policy. Now, the monetary policy. As I mentioned earlier, monetary policy is a macroeconomic tool employed by Reserve Bank of India to influence money supply in the system, to influence money supply in the economy. Here, the Reserve Bank of India uses various policy instruments to achieve the objectives of full employment, economic stability, price stability, removing disequilibrium in the balance of payment. You remember like this: economic growth, price stability, full employment, and achieving disequilibrium in the balance of payment. So these are the objectives of macroeconomic policy. Here you have, see, now you have concentrated on only one concept, money supply. But in developing economies like India, monetary policy, the Reserve Bank cannot confine only to money supply. In a developing economy like India, there has to be continuous expansion of money supply and bank credit. Remember these two, this one. So at the beginning I told, monetary policy is a policy adopted by Reserve Bank of India in regulating the money supply. But monetary policy, the Reserve Bank cannot remain confined only to the money supply. In a developing economy like India, there has to be a continuous expansion of money supply. On one hand, money supply should rise. On the other hand, bank credit also should rise. Bank credit. Because whenever banks provide more credit, then only you will find more economic activities. There will be more economic activities. If there are more economic activities, more employment opportunities will be provided. Whenever there were more employment opportunities, production also will be high. Higher production would contribute for higher national income of the country. Our GDP growth also accelerates. So it is the responsibility of the Reserve Bank of India to see the credit requirements are met by the economy. So there should be sufficient credit flow to all sectors of the country. There should, see, for example, now you might have observed about MSME sector, because MSME sector accounted for 35% of the country's exports, and MSME sector accounted for even 35 to 40% of the total GDP of the country. So thereby, there should be continuous credit flow to the MSME sector. The government encourages the banking sector to provide more credit to MSME sector. Like that, small and marginal farmers in the agriculture sector should be protected. Thereby, there should be adequate credit flow to small and marginal farmers, particularly for agriculture sector, in order to accelerate economic growth of the country. So it is the responsibility of the Reserve Bank of India to see the credit requirements are met in the system. The Chakravarti Committee, in old papers you will find about Chakravarti Committee. The Chakravarti Committee has emphasized the importance of monetary policy by highlighting its objectives. These are the objectives of monetary policy according to Chakravarti Committee: price stability, growth, equity and social justice, promoting new monetary and financial institutions. So there should be equal opportunities to all, and we have to achieve social justice, and we have to promote new financial institutions also, new financial institutions. See, for example, since 1980s, you might have observed number of term lending institutions and a number of, at the same time, refinancing institutions also. In some of the examinations you might have observed, for example, if you take NABARD is a refinancing institute. The main objective of the NABARD, refinancing. The main objective of the National Housing Bank, refinancing. Main objective of SIDBI, refinancing. Term lending corporations, all developing institutions are term lending institutions. For example, if you take IDBI, IFCI, which was set up in 1948, ICICI 1955, IDBI 1964. These are all developmental institutions. In every state you will find self-finance, state finance corporation. Like that, here you will find Telangana Government State Finance Corporation, Telangana Government Industrial Development Corporation. These are all term lending institutions. So, like that, we have to promote new monetary and financial institutions. These are the objectives of monetary policy according to Chakravarti Committee. However, monetary policy should emphasize the objectives of, though I have highlighted number of objectives, the monetary policy should emphasize the major objectives of the economic growth with price stability. These are the two important objectives of monetary policy. For example, if any question comes in the exam, you highlight the objective of price stability. The main objective of monetary policy is price stability. The next one, so we have seen some of the objectives at the beginning, later according to Chakravarti Committee also we have seen. And as you see at the end, we can say the monetary policy aims at accelerating the economic growth in the country. How can we accelerate economic growth? There should be sufficient credit flow to various sectors of the economy, not only for agriculture, industry and service sectors also. Thereby, if there is an adequate credit flow to all sectors, production would rise, it would contribute for higher economic growth. Next, there is a need to achieve price stability. There is a need to achieve full employment. Full employment, just you remember, what is full employment generally? For example, we have natural resource, we have capital resource, we have human resources. Exploiting all the natural resource, capital resource and human resource is full employment. Not only human resources, providing employment to human resources, also some people used to say it is a full employment. If you provide employment opportunities to all, some people used to say this is to term it as a full employment. But actually in economics, full employment means exploiting all the resources available in the country. But we are not exploiting all the resources available to the maximum extent. For example, if you take a natural resource, if you take land, still 14% of the land is not suitable for cultivation. And at the same time, you will find some more categories of lands, grazing land, fallow land, such kind of lands also you will observe. And as far as the irrigation water resources are concerned, we are not exploiting all the water resources to the maximum extent. So like that, you are not exploiting all the resources available to the maximum extent. Thereby we can say the Indian economy has not achieved full employment. So there are some, see like that you will find some problems related to the objectives of the, achieving the objectives of the monetary policy. Now, see, for the sake of you, just I will take only 5 minutes to explain the measures of money supply, because these concepts also you will find from the some of the question papers. This one, since till 1997, we have the Reserve Bank of India has used these 4 indicators, 4 measures for measuring the money stock. The Reserve Bank of India has employed 4 measures of money stock till 1997. This is reserve money. Reserve money. Reserve money is nothing but currency and coins held by the public. Whatever the currency and coins held by the public, plus bankers deposit with RBI. See, for example, every commercial bank maintains a certain amount of their deposits with the Reserve Bank of India. If State Bank of India attracts 100 crores of deposits, out of 100 crores, State Bank is required to keep a certain percentage of deposits with the Reserve Bank of India, plus other deposits with the Reserve Bank of India. Here I have defined what are the other objectives. See, what are the other deposits with the Reserve Bank of India. The other deposits I have defined here like this. It comprises deposits of quasi-government. Quasi-government means, for example, it is established by law and not directly related to government, not directly related to government. For example, if you take SEBI, if you take, for example, National Human Rights Commissions, these are the quasi-governments established by law, perform certain functions, and it works under the government only, but at the same time it is not directly related to government. So the deposits of the quasi-governments and primary dealers. Primary dealers means, for example, just you note down such concepts. Primary, who are the primary dealers? Financial institutions authorized to buy and sell government securities. Those are the primary dealers. Financial institutions authorized to buy and sell government securities. Those people are primary dealers. The deposits of the primary dealers comes under other deposits of RBI. At the same time, the balance in the accounts of foreign central banks and governments and accounts of international agencies such as International Monetary Fund. The next one, M1. M1 is nothing but narrow money. In some of the question papers, you might have observed this. It is nothing but, why it is called as narrow money? Why it is called narrow money? It is, see, completely liquidity. You will find all complete liquidity here. Sum of currency with the public plus net demand deposits of all commercial banks. Net demand deposits held by the commercial banks. That is M1. For example, currency and coins held by the public plus demand deposits of all commercial banks. Demand deposits held by the commercial banks. For example, we maintain saving account in the commercial bank. In any commercial banks, you might be maintaining saving account. So from saving account, you will find some amount, that amount. So currency and coins held by the public plus demand deposits of all commercial and cooperative banks. That is M1. And M1 is also called liquid money. This is completely liquid money. Next one, M2. M1 plus the saving deposits with the post office savings organization. Saving deposits with the post office saving organization. M3 is nothing but broad money. M1 plus time deposits held by the public in all commercial and cooperative banks. M1 plus time deposits of the commercial banks. Time deposits with the banking system. M4, M3 plus time deposits of Post Office Savings Organization. So these are the four concepts employed by Reserve Bank of India till 1997 to measure the money supply. See, from just if you go through the old papers of some of the exams, you will find M1 and M3, you might have observed that. M1 and M3. M1 is liquid money, nothing but narrow money. M3 is broad money. So here, in 1998, see, since 1998, these four concepts came into existence. For example, there you have seen currency notes, and in the earlier slide you have seen currency notes and coins held by the public, demand deposits of all commercial and cooperative banks, other deposits of Reserve Bank of India, time deposits of commercial banks, time deposits of Post Office Savings Organization. Only 6 items you have observed from the traditional measurement of money supply, traditional, which was in existence till 1997. But here it was broadened completely. Money supply measurement was broadened on the recommendation of Reddy committee. The 4 monetary aggregates came into existence. 4 monetary aggregates on the basis of balance sheet of the banking sector in conformity with the norms of the progressive liquidity. So since 1997, the Reserve Bank of India is measuring NM1, NM0, NM1, NM2 and NM3. As far as NM0, this is monetary base or reserve money. So for that, NM0 monetary base or reserve money consists of currency, the currency and coins held by the public, bankers' deposits with the Reserve Bank of India, and other deposits with the Reserve Bank of India. Other deposits, already you have seen the various components comes under other deposits. NM1, this is narrow money only. It consists of currency with the public plus current deposits with the banking system plus demand liabilities portion of saving deposits with the banking system and other deposits with the Reserve Bank of India. So it was elaborated by just by incorporating some of the new items related to money supply. Thus, NM1 includes currency with the public plus non-interest bearing deposits with the banking sector, including that of Reserve Bank of India. NM2 is the sum of NM1 plus short-term time deposit of the residents, short-term time deposits of the residents. NM3 is the broad money. It is the sum of NM2 plus long-term time deposits of the residents plus call or term funding from the financial institutions. Call funding means their duration would be 1 to 14 days. Term means it will be for more period. So NM3 captures the complete balance sheet of the banking sector. These are the liquidity aggregates. The same working group has recommended some of the liquidity aggregates also. The liquidity aggregates can be seen in the form of L1, L2 and L3. L1 is nothing but NM3. Already you have seen NM3 as a monetary aggregate. NM1, NM2, NM3 are monetary aggregates which came into existence since 1998. So NM3 and all deposits with the Post Office Savings Bank. This is L1, liquidity 1 is a sum of NM3, already you have seen NM3, plus all deposits with the Post Office Savings Bank, excluding National Savings Certificates. L2 is the sum of L1, same, all components of the L1 can be seen here also, plus term deposits with the term lending institutions. Term lending institutions are nothing but development financial institutions. Already I have mentioned state financial corporation. Every state will have state financial corporations, state industrial development corporations, and all development financial institutions. You might have heard about ICICI, IDBI, and IRCA, Industrial Reconstruction Corporation of India, and you might have heard about IIBI. These are the term lending institutions. and refinancing institutions. Refinancing means NABARD, National Housing Bank, National Housing Bank, SIDBI. These are the refinancing institutions. And certificate of deposits by financial institutions comes under L2. L3 is the sum of L2 and public deposits of non-banking financial companies, NBFC. You might see, how many of you are aware of NBFCs? Non-banking financial companies. So here, the money supply under non-banking financial companies also have been taken into account while measuring the liquidity aggregates L3. We will come to that later. These are the instruments of money supply. In most of the papers you might have observed CRR, marginal standing facility, repo rate. In almost all 90% of the papers, if you go through the old question papers, questions will be designed like that. Which one of the following is not a quantitative measure? Quantitative measure. Which one of the following is a qualitative credit control measure? Here you remember, the main objective of the Reserve Bank of India is credit control. Credit control. Reserve Bank of India issue currency notes. The duty may be assigned by government to any other bank, other institution also. The method adopted by Reserve Bank of India in issuing currency notes is minimum reserve system. Minimum reserve system. According to minimum reserve system, Reserve Bank of India should maintain at least 200 crore rupees worth of gold and foreign currency. So if Reserve Bank wants to print a new currency, it should be backed by 200 crore rupees worth of gold and foreign currency. Out of 200 crores, the worth of gold should not be less than 115 crores. This is about minimum reserve system. So, generally, Reserve Bank issues currency notes. Monopoly in issuing currency notes, that is okay. It acts as a banker's bank. It acts as government bank. And it is a custodian of nation reserve. But the main function of Reserve Bank of India is credit control. Credit control. So in order to control credit, the Reserve Bank of India adapts both quantitative and qualitative measures. The quantitative measures are bank rate, open market operations, cash reserve ratio, statutory liquidity ratio, repo rate, reverse repo rate, and marginal standing facility. The first one, bank rate. It is nothing but rate of interest charged by Reserve Bank of India on the loans and advances given to commercial bank. For example, if State Bank of India approaches Reserve Bank of India for a certain kind of assistance, for a loan amount of some amount, then the Reserve Bank will impose a certain rate of interest. So charged by Reserve Bank of India on the loans and advances given to commercial banks. That is bank rate. And in some of the exams I have seen, discounting bills of exchange, also correct. Discounting the bills of exchange. That is also correct, bank rate. The next one, open market operations. Here, the Reserve Bank of India performs open market operations. Buying and selling of securities in the open market. Buying and selling. Reserve Bank buys government securities in the open market, and Reserve Bank sells government securities in the open market, depending upon the situation. So generally in competitive exams, generally they will interpret related to business cycles. During recession, what kind of open market operations will be performed by Reserve Bank of India? So open market operations is nothing but buying and selling of securities in the open market. Cash reserve ratio. As I mentioned earlier, every commercial bank is required to keep a certain portion of deposits with the Reserve Bank of India. If Indian Overseas Bank attracts 1,000 crores of deposits during 2025-26 financial year, it has to keep the 6% with the Reserve Bank of India. It has to keep 6% with the Reserve Bank of India. Statutory liquidity ratio. Commercial banks have to maintain a certain portion of their deposits, in the form of liquid assets. Liquid assets. It was given in 2016 or 17 civils exam. In the prelims exam, same question is given, SLR. So, the commercial banks have to keep a certain portion of deposits with the Reserve Bank of India, that is CRR. In addition to that, commercial banks are required to maintain a certain portion of their deposits in the form of liquid assets, either in the form of gold or in the form of securities. Liquid asset means you know that anything which can be converted into cash immediately, anything which can be converted into cash immediately. In that form, the commercial banks have to maintain 18% of their deposits, that is statutory liquidity ratio. And repo rate. It is also Reserve Bank of India charges a certain percentage of interest on the loans and advances given to commercial banks for a short period of time, that is repo rate. Reverse repo rate. So it is at 3.5% at present. For example, if you take a Canara Bank, see the Canara Bank amount, the 50 crores amount was remained with the Reserve Bank of India for 2 or 3 months. Based on the time period, the Reserve Bank of India pays a certain percentage of interest to the commercial bank. So, repo rate is nothing but short-term interest rate charged by Reserve Bank of India on the loans and advances given to commercial banks. Reverse repo rate is nothing but the Reserve Bank of India pays a certain percentage of interest on the deposits held by commercial banks. Marginal standing facility, very important concept. For example, in order to avoid overnight interest rate fluctuations, Reserve Bank of India provides loans to commercial banks at 1% of interest. See, for example, the interest rate would be higher than repo rate. For example, if the repo rate is at 6%, the interest rate related to marginal standing facility will be more than 6%. In simple terms, we can say penal rate of interest also, penal rate of interest. For example, if any commercial bank is in crisis, now they have approached the Reserve Bank of India for a certain kind of assistance in terms of loan, sanctioning of loan. The Reserve Bank sanction a certain amount of loan to the particular commercial banks on higher rate of interest. So, in order to avoid overnight interest rate fluctuations, the Reserve Bank of India charges a certain percentage of interest on the loans and advances given to commercial banks. So, it would be higher than repo rate. The next one, qualitative. See, in some exams also you can observe. In 2012, if you observe the civil service main paper, now you are aware of the concept of monetary policy. Do you think that monetary policy has succeeded in achieving the objectives? That is one question. And the monetary policy works as a stabilization measure only, stabilization. It only tries to stabilize the economy, substantiate the statement. These are the two questions in the in 2012 in economics main exam. Here generally we say, economists used to say, every time you are observing, during American crisis also you have observed, the Reserve Bank of India reduced CRR and repo rate in order to promote liquidity. During COVID-19 period also you have seen, Reserve Bank reduced CRR and repo rate in order to promote liquidity. And in the recent years also now you are observing. For example, repo rate was reduced by 25 basis points, and again 10 days before again reduced by 25 basis points. So, every time you are focusing heavily on CRR and repo rate, both, you are neglecting the qualitative credit control measures. Some economists used to say, the Reserve Bank always focuses on the quantitative credit control measures, and it has neglected the qualitative measures. Some people, critics used to point out Reserve Bank of India. At the same time, you might be aware of priority sector lending. Priority sector lending means out of the total loan provided by Canara Bank, 40% should be given to priority sector, 40%. If Canara Bank sanctions 100 crores as a loan amount to different sectors, out of 100 crores, 40 crores should be given to priority sector, priority. Agriculture, small scale industry, and for artisans. Recently, education and health also became a part of priority sector, priority. So, in order to protect the priority sector only, national commercial banks were nationalized in 1969. Because before 1969, the loan amount, out of the total credit, agriculture has received only 3% of the credit. Out of the total credit of the banking system, because at that time, the banking system was in the hands of the private sector, private. So they have neglected priority sector, neglected the complete priority sector. More than 80% of the credit was given for trade and commerce, Agriculture has received only 3% of the credit. So as a result, in order to promote priority sector, Indira Gandhi government announced nationalization of banks in 1969. So here, margin requirement. Margin requirement means if you show 100 rupees worth of security to any bank, State Bank of India, they will not lend to the full value of security. Your security value is 5 lakhs. Commercial bank will not lend to the full value of security. You will not get 5 lakhs. It maintains margin. Out of the total value, 80% may be given in the form of loan. You may get 3 lakhs only as loan. Commercial banks will not provide full value of securities. Will not provide the loan as based on the full value of securities. So it all depends upon, sometimes margins will be raised, sometimes margins will be lowered, depending upon the situation in the country. If the economy is experiencing slow growth, then what RBI will do? RBI will adopt cheap money policy. Thereby margins will be reduced. You will get more money based on the security that you have shown to the particular bank. Next, consumer credit control. Commercial banks provide loans to the customers for purchasing durable commodities. Any AC machine, refrigerators. In order to purchase durable commodities, commercial banks provide credit to the customers. So depending upon the situation, the credit will be controlled, and they may charge a higher rate of interest on the loans given to the people for purchasing durable commodities. Sometimes it may be relaxed also, because in order to promote automobile industry, commercial banks may come forward in terms of providing loan for purchasing automobile products at a low rate of interest. If they provide loan at low rate of interest, there will be more demand for automobile products. So it all depends upon the economic situation prevailing in the country. At the same time, credit rationing. Sometimes, see for example, you might have heard about sometimes gold loans will be stopped. Based on the gold, commercial banks may not provide loans sometimes. So here rationing method will be followed, rationing for certain amount of securities only, for certain purposes only, commercial banks will provide credit. Certain purposes. Rationing means you know that. So out of the total economic activities, only for certain economic activities, loans will be provided to the public by the commercial banks. Rationing. At the same time, direct action. The Reserve Bank of India may impose penal rate of interest if money borrowed by commercial bank beyond a limit. So you have exceeded your limit. So if you approach Reserve Bank of India for an additional loan amount, the Reserve Bank of India charges penal rate of interest on money borrowed by the commercial banks beyond a particular limit. Publicity. The Reserve Bank of India, publicity means Reserve Bank of India will publish the balance sheet. From assets and liabilities, you will come to know, see what kind of monetary policy Reserve Bank of India follows hereafter. Moral suasion. It is a persuasion or request made by Reserve Bank of India to all the commercial banks to cooperate with monetary policy of the government, monetary policy of Reserve Bank of India. Persuasion, because I will try to persuade you to study well. Like that, RBI will persuade all the commercial banks to cooperate with the monetary policy of the government, monetary policy of Reserve Bank of India. Now here, these are the very two important aspects. Simply you remember, to address slow growth, Reserve Bank adopt expansionary monetary policy. For example, I have already mentioned about expansionary policy. During American crisis, we have followed expansionary policy, because due to American crisis in 2008-9, we have achieved only 6.9% of growth, 6.9. Before that year, before American crisis, 2007-8, 9.8% of growth achieved by Indian economy, 9.8. But due to American crisis, the growth rate was limited to 6.9 only. So, in order to address a slow growth, there is a need to promote economic activities. Thereby, Reserve Bank of India adopted cheap monetary policy. So, in one of the examinations, just from the question paper, just I have seen, to address a recession, all of you just remember, if slow growth continues for about 1 year, some economists used to say 2 quarters only, 2 quarters. Quarter means 3 months. Economy will get into recession. Some people used to argue like that. But as far as the India is concerned, just you can say 4 quarters, 1 year. If slow growth continues for a long time, that is for about 1 year, economy will get into recession. If recession continues for a long time, economy would get into depression. Slow growth, recession, depression. In order to avoid slow growth, recession and depression, expansionary monetary policy is to be employed by Reserve Bank of India. Here, the contractionary, to check inflation, assume that Indian economy is experiencing severe inflationary pressures. Just now I have mentioned, due to American crisis, Indian growth rate was limited to 6.9% in 2008-9. Thereby, we have adopted expansionary monetary policy. The expansionary monetary policy contributed for revival of the country. It has contributed for revival of the country. Next, we have seen higher growth in India. In the subsequent years, we have seen higher economic growth. But everywhere you remember, it is also a question in the from essay, general essay, you will find that. Already old paper, civil service. Higher economic growth is always associated with higher inflationary pressure. Justify your answer. Higher economic growth is always associated with higher inflationary pressure. Because from the beginning I told that one of the objectives of the monetary policy is accelerating economic growth, I told. But if you take steps to accelerate economic growth, it would lead to inflationary pressures. Same thing happened. In 2010-11, we have achieved higher economic growth. At the same time, the inflationary pressures prevailed in India. So from 2011-12 to 2010-11, there were more inflationary pressures. Because you have adopted expansionary policy before that. The expansionary policy contributed for rise in money supply. And you have provided 3 crores of fiscal stimulus. You might have observed in the question papers also. Fiscal stimulus. Because due to American crisis, IT sector, construction, automobile industries were affected. So in order to revive these sectors, the government of India announced 3 lakh crores of fiscal stimulus. And on the other hand, Reserve Bank has adopted expansionary monetary policy. All these factors contributed for rising inflationary pressure. So higher economic growth is always associated with higher inflationary pressures. So to address inflationary pressure, Reserve Bank adopt contractionary monetary policy. What RBI will do as part of contractionary policy, Reserve Bank of India will raise the bank rate, because the Reserve Bank of India takes steps to reduce money supply, It raises the bank rate. It sells securities in the open market. Because people should not have excess money in their hands. I have to reduce money supply in the system. Reserve Bank raises CRR. Reserve Bank raises SLR. Reserve Bank raises repo rate. That is the contractionary monetary policy. So Reserve Bank takes all possible steps to reduce money supply during inflationary period. Reserve Bank takes all possible steps to enhance money supply during recession or slow growth. Otherwise, during depression periods also. Now, everything I have given, again I need not explain this actually. And now, the very important topic, only that entire lecture is divided into 3 parts. Only one part only I have completed. But actually second one and third one is also most important. Inflation targeting. Here, inflation targeting is a monetary framework where the central bank explicitly set a publicly announced inflation rate. Reserve Bank announced the inflation will be maintained at 4% during this year, like that. It will announce a publicly announced inflation rate to steer the economy towards the goal. Your goal is achieving price stability. Main objective of the monetary policy is price stability. So Reserve Bank announced the inflation rate. Here the inflation targeting aims at keeping the inflation rate within a specific range, ensuring price stability, at the same time promoting confidence among the economic system. So there is a need to promote economic confidence, and there is a need to maintain price stability. That is why inflation is to be maintained within a specific range. And now the inflationary targeting is a forward-looking policy approach. As far as the forward-looking approach is concerned, here we say the policymakers, generally policymakers, they expect what the inflation rate will be in the near future. For example, if you ask me what would be the Indian currency value, today Indian currency value against American dollar is 83 rupees, assume like that. If you ask me what would be the India's currency value against American dollar by December 2025, for that I will employ different techniques: judgmental forecasting, technical forecasting, fundamental forecasting. Based on these methods, I will forecast the India's currency value by December 2025. In the same manner, inflation rate also can be forecasted. So the policymakers, it is a forward-looking approach. The policymakers takes some important decisions based on expected inflation, For example, if you are able to forecast India's currency value by December, based on that you will take some important decisions. You will come up with different agreements with the foreign companies located abroad. For that you need forecasting of inflation forecasting, and at the same time exchange rate forecasting also. So thereby we say it is a forward-looking approach. Now just you concentrate here, the very important one. There was one committee, Urjit Patel committee chose CPI, Consumer Price Index, as the inflation metric rather than wholesale price index. For example, in India for a longer period of time, to measure inflation, wholesale price index was in existence. We have used wholesale price index. Now we are employing consumer price index. So Urjit Patel committee chose consumer price index as an inflation metric instead of wholesale price index. Urjit Patel Committee recommended Reserve Bank of India to adapt CPI combined, consumer price index combined. You remember, consumer price index will be calculated separately for both rural area and urban area. You will also find consumer price index combined. So he has advised Reserve Bank of India, use consumer price index combined as a measure of nominal anchor for policy communications. So the nominal anchor or inflation target was defined as headline inflation, headline. In some of the examinations you might have observed, headline inflation and core inflation. Headline inflation takes into account all goods and services, complete goods and services. Food and energy, see, you will find volatility in food and energy, fluctuation in food price, fluctuations in energy price. Headline inflation takes into account volatile commodities also, but core inflation will not take into account volatile prices. So the nominal anchor or inflation target is defined in terms of headline inflation, because the headline inflation reflects the cost of living, and based on that you can also assess the inflation expectations. So it helps the policymakers to expect inflation in the coming days. So there was an agreement between the government and Reserve Bank of India to adapt flexible inflation targeting approach. There was an agreement between government and Reserve Bank of India to adapt flexible inflation targeting as an official goal of Reserve Bank of India. Remember that. Flexible inflation targeting as an official goal of Reserve Bank of India. In 2015, the agreement was made in 2015. Now, if you take some of the countries, some countries follows point inflation, while some other countries follows flexible interest rate targeting. Some countries follows point target. For example, if you take the America's central bank, Fed Reserve maintains the inflation rate at 2%. That is point target, point. But in India, Urjit Patel Committee has set the inflation target at 4% within a band of plus or minus 2%. In and around it. This is not a point inflation method. This is not point target. This is flexible inflation targeting. But some countries adopted point target, while other countries have adopted the flexible inflation target. As far as this inflation targeting is concerned, it was in practice in some of the economies: New Zealand, Australia, Canada, Finland, Israel, Spain, Sweden and UK. In these countries, inflation targeting was in practice. It was in practice. At the same time, for example, I told at the beginning, the Reserve Bank of India determines the policy rate required to set the target for inflation. Reserve Bank of India set the policy rate. Policy rate will be set. Why the policy rate was set? For example, you have seen recently Reserve Bank of India reduced repo rate by 25 basis points. It has decided the policy rate. It is required to attain that inflation target, to achieve that inflation target. So, if Reserve Bank expects that there would be more inflationary pressure in the coming days, it will raise the policy rates. If Reserve Bank expects that there would be low inflation, that there would be deflation. So now, compared to the earlier period, now prices are coming down in India. So as a result, Reserve Bank reduced the repo rate. So if the Reserve Bank expects that there would be higher inflation in the coming days, it raises the policy rates. If Reserve Bank expects that there would be deflationary tendencies, deflation, then it would reduce the policy rates. So Reserve Bank sets the policy rates required to meet the inflation target, required to attain the inflation target. Now here further, you might have heard about Monetary Policy Committee. Section 45ZB of the RBI Amendment Act. RBI Amendment Act 1934 provides for an empowered six-member committee to be constituted by central government. The central government constituted Monetary Policy Committee in September 2016. So, the Monetary Policy Committee meets at least 4 times in a year. The Monetary Policy Committee determine the policy rates. It determines the policy rates required to meet the inflation target. And here you will find Monetary Policy Department in Reserve Bank of India. Monetary Policy Department. The Monetary Policy Department of Reserve Bank of India assist Monetary Policy Committee to formulate the monetary policy. Monetary Policy Department assist the Monetary Policy Committee in formulating the monetary policy. There was one more department, Financial Market Department, Financial Market Operations Department. Financial Market Operations Department. There was one department. It was also given in some of the exams. Financial Market Operations Department. What is the duty of this department? Actually, this department operationalized the monetary policy through day-to-day liquidity management operations. See, for example, every month you will find the amount of currency and coins held by the public, data. You will find the data. Reserve Bank of India publishes the data. Net demand deposits held by the commercial banks, you will find the data. So, the day-to-day liquidity management operations will be performed by Financial Market Operations Department of Reserve Bank of India. And now, as I mentioned earlier, the Fed Reserve fixes the interest rate. It maintains inflation target at 2%. For us, I told 4% within a band of plus or minus 2% in and around it. But Fed Reserve fixes the inflation rate at 2% using, because I told earlier, for example, here nominal anchor for inflation targeting in India is CPI combined. Continuation to that, you remember headline inflation. CPI combined. But America, US Fed Reserve employs Personal Consumption Expenditure Price Index. That is the inflation metric for America. But most of the central bank employs CPI, Consumer Price Index only, as inflation metrics. Here I have mentioned, for example, New Zealand uses a CPI. Bank of Canada, CPI only, Consumer Price Index. Bank of England aims to maintain 2% inflation rate. It also employs CPI and it also uses interest rate also. Israel maintains 1 to 3% of inflation, 1 to 3%, they range. They also employ CPI with fixed interest rate. For us, I told, CPI combined, it takes into account headline inflation, like that I told. So these are the various metrics employed by various central banks while fixing the inflation rate. Now here I have given, see, for those who are appearing for main exams like that, generally questions will be given like this: effectiveness, the effectiveness of the inflation targeting. For example, for that you have to take some studies like this: whether a monetary policy committee has succeeded in addressing the inflationary fluctuations or not, whether India was able to achieve the targeted inflation in the country or not. For example, 2016-19. So during this period, India formally adopted inflation targeting framework. Already told that. India formally adopted inflation targeting framework. So the monetary policy committee, the role of the monetary policy committee is to adjust the policy rates based on inflation trends. But what they did here, in April 2015, the repo rate was at 6.50, but it was reduced to 5.15% by October 2019. 2016 to 2019. In 2016, repo rate was kept at high. By 2019 October, repo rate was lowered. It was lowered to support economic growth, to support the economic growth. So to support economic growth, NPC reduced the repo rate. So as a result, this period demonstrated that a well-structured monetary policy committee can effectively anchor inflation expectations and ensure macroeconomic stability. So here from this we can say the monetary policy committee has succeeded in determining the policy rates to meet the requirement of inflation target. So this one during 2020 COVID-19, here the response all of you are aware, already told that. During this period, Reserve Bank of India adopted expansionary monetary policy, because there was slow growth. You might have observed in 2020-21, we have the economy registered negative growth. So expansionary monetary policy was mandatory at that time. So the Reserve Bank adopted expansionary monetary policy. It has reduced CRR and repo rate to promote liquidity in the system, because during COVID period, all of you might observe, the unemployment was at high, more unemployment. At the same time, the Reserve Bank of India has reduced the policy rates on one hand. The government adopted direct benefit transfers, particularly that for the vulnerable sections of the people. Government directly deposited a certain amount of money into the disadvantaged groups of the people in the society. Direct benefit transfer. Both the government and the Reserve Bank of India, both of them have taken effective steps to promote the livelihood of the people, to enhance livelihood of the people. So thereby, during this period, pandemic led to sharp economic contraction. Just now I told, economic activities have come down. Unemployment rate was at high unemployment. So what MPC did, Monetary Policy Committee did, slashed repo rate from 5.15 to 4% to boost liquidity. Repo rate was reduced to boost liquidity. Announced a moratorium on loan repayment. The Reserve Bank government has directly announced it has imposed a moratorium up to 6 months. Unable to recollect that actual period. Said you don't pressurize the people. See, if they fail to pay the EMIs. Moratorium on the loan repayment also one of the steps. And conducting long-term repo operations to inject liquidity. So RBI injected liquidity into the banking system. So these are the steps taken up by Monetary Policy Committee. The outcome is helped business to survive. You have seen that since 2020-21 onwards, the economy was revived. At present, the entire world economy is experiencing on an average 3 to 4% of growth only. But Indian economy was able to maintain 7% of growth. And boosted credit availability, but inflation remained a concern. The key insight is flexibility of monetary policy. There was some flexibility of the flexibility is there. Flexibility of the monetary policy in responding to economic shocks, but also highlighted risk like higher inflation due to excess liquidity. Already I mentioned, in 2010-11, we have experienced higher inflation because of this kind of policies only, 2010-11. So thereby, whenever there was higher inflation, in 2010-11, Reserve Bank adopted tight monetary policy. Tight monetary policy means contractionary. Bank rate will be raised, CRR will be raised, repo rate will be raised. So thereby liquidity will be low. As a result, from 2011-12 to that period also all of you remember, 2011-12, 12-13, 13-14, average growth rate in India was registered at 5 to 5.5% only, 5 to 5.5 only during these 3 years. So the tight monetary policy has shown some adverse impact on the system. The GDP growth was slowed down during these 3 years. Here, post-pandemic Russia and Ukraine war. Here also you are aware, the entire world economy experienced inflationary pressure, global inflation. Primary commodities prices have gone up, primary commodity prices. Energy prices have gone up. Russia, Ukraine alone accounted for 30% of the wheat production in the world, 30% of wheat production. As because of war between these two countries, they are unable to export wheat to the rest of the world. So as a result, entire world economy experienced a shortage of food grain. So entire world economy experienced inflationary pressures, inflation. So inflation means what now? What government has to do? Government is required to adapt some tight policies only, contractionary policies. So here you see the monetary policy reaction. Repo rate hiked. Just now I told tight policy. Because there was global inflation, India also experienced higher inflation. So as a result, to address inflationary pressures, the repo rate was raised from 4 to 6.50%. At the same time, withdrawn accommodation stance to tight money supply. So it has taken some steps to curb higher growth in money supply. And outcome is inflation gradually reduced. As because of rise in repo rate, as because of tight policy that you have adopted, the inflation gradually declined. Growth remained resilient, showing a balanced policy approach. The key insight is demonstrated monetary policy committee's ability to manage inflation despite the global uncertainties. This is the outcome, key insight of here, demonetization. You are aware, government has withdrawn 500 rupees and 1000 rupees note from its circulation. So during that time, the monetary policy response is RBI injected liquidity to prevent a banking crisis. It has injected liquidity. So why? In order to address the shortage of liquidity, maintained an accommodative stance to support economic recovery. The outcome is short-term economic slowdown, but increased formalization of digital transactions. Now you have been observing digital transactions, growth in digital transactions since this period only, digital transactions. And inflation remained under control due to weak demand. Because see, more than 98% of the money was earlier, it has gone to the banks again. But during that period, we have observed lower money supply in the economy, lower money supply. Agriculture sector was also affected. Agriculturists have not received adequate amount of money on time from the banks. That is why agriculture sector also experienced some uncertainty during demonetization period. So for a shorter period of time, there was shortage of money supply. Due to shortage of money supply, if the money supply is shortage, there will not be that much of demand for goods and services. There will not be excess demand. Thereby inflation will be controlled. So this is the outcome of the policy the monetary policy committee followed during the demonetization period. Okay, such type of question comes, for example, only success stories only I have explained. There are some limitations on the part of inflation targeting, limitation. For example, the inflation targeting may not address supply shocks. Supply shocks are structural constraints which affect the economy. For example, we doesn't have adequate infrastructure in the country. If you provide more infrastructure, it is from supply side you have to see infrastructure. If government provide any tax benefit, it is a supply side factor. Supply side factor. So the inflation targeting may not be more effective. Critics are pointing out, critics. It may not be more effective because it unable to address the supply shocks. You know that the Indian economy is experiencing the lack of infrastructure development. We had plans to invest $100 billion on infrastructure. For example, as far as infrastructure, you might have observed, if you take the road, at the time of independence, we had road length of 4 lakh kilometers. Roads were developed 4 lakh kilometers of road. Now it was in between 45 to 50 lakh kilometers. As far as the Indian railways, if you observe railway route length, at that time only it was nearly 53,000 crores, 53,000 kilometers, because the British has focused more on railway sector development. Now it has reached to 69,000 kilometers. If you take energy, at the time of independence, India had the power generation capacity, installed power capacity was 5 billion kilowatts. Now it has reached to 350 gigawatts. You may find some variation in the data, 360, 370 like that. Nearer to that, I told 350 gigawatts. Our power installed capacity raised to that extent. Though infrastructure raised in this manner, still it is not adequate to promote higher economic growth in the country. So some critics are saying like that. Supply shocks are there. For example, now American President Trump raised tariff on Indian products. Thereby what would happen? It is supply side only. You have to observe it is supply side. It is a supply shock. So like the tax, creation of infrastructure, such things have to be treated as supply shocks in the economy, and structural constraint is also there, structural constraint. So as a result, the inflation targeting may not be effective. One more important thing you remember, already I told, CPI combined is the inflation metric for India, I told. For flexible inflation targeting, you are taking CPI combined, I told. For that, to construct CPI combined, you are taking base year as a 2011-12. That is the base year. Later it was revised by taking into account 2015 as the base year. Though it was revised by taking 2015 as the base year, still there are some commodities which are not necessary. Such commodities are also involved, are included in that basket. Because I told CPI combined has a comprehensive coverage across the regions and all goods and services. CPI combined has a comprehensive coverage across regions and all goods and services. So like that some critics are pointing out, and some critics says, okay, you told about a tight monetary policy to check inflation, tight monetary policy, the policy that you are suggesting, but Reserve Bank of India experiences a difficulty at the time of the tight monetary policy that it has adopted. Because I told that 2010-11 tight monetary policy adopted, tight. So because of tight monetary policy, the Reserve Bank itself is experiencing some difficulty. Critics are pointing out, in order to achieve balance between economic growth and price stability. Because I told that though there are 5 or 6 objectives that you have seen, I told you monetary policy should emphasize the achieving the objectives of price stability and economic growth. Reserve Bank unable to achieve balance between economic growth and price stability during the tight monetary policy time. At the same time, if the interest rate fluctuates in this manner, the most disadvantaged group people also will get affected. Like that, people are commenting like that. You are changing interest rates like this. As because of change in interest rates, some disadvantaged groups, vulnerable section of the people are getting affected. And some critics also, not only critics, even you can say exchange rate volatility. You have been observing depreciation of Indian currency against American dollar. On one hand, you have targeted inflation, okay, that is okay. But on the other hand, you have been experiencing exchange rate stability. Exchange rate is not stable. Exchange rate instability you are observing. Our currency value is fluctuating. Every day you are finding some fluctuations in Indian currency value. So the inflation targeting has not been contributed for volatility in the currency value. So at the same time, as because of volatility in your currency value, your foreign exchange transactions are getting affected. Foreign exchange transactions are getting affected. Some people say, for example, portfolio investments, portfolio. During American crisis period, on a single day, $11 billion of investment was withdrawn by the foreign investors. Foreign portfolio investment. The situation of foreign portfolio investment has not changed till now, though you have targeted inflation. You have targeted inflation, but sometimes, see, for example, if any news comes to the market, for example, if any news, for example, I am saying that, see, for example, see, if you assume that there was a news in the market that the government at center will collapse in the next 2 or 3 months, then it will have an impact on the stock market. Thereby, foreign institutional investors withdrew money from the stock market. So it is happening, every time it is happening, you are observing. On one hand, inflation target success, I explained. It was succeeded in achieving the targeted inflation, in achieving the inflation target, I told. But still, foreign portfolio investment situation has not been changed. Still, there is a variation in the capital flows. Sometimes capital flows into the country will be high, sometimes it will be very low. Foreign portfolio investment situation has not been changed. And as because of tight policy, Reserve Bank unable to achieve balance between economic growth and price stability. These are the various loopholes as far as the inflation target, this inflation targeting implementation in India is concerned. Targeting mechanism in India is concerned. The next one, monetary policy transmission, third part. Here, just I will simplify. Actually, this question can be expected in the, see, there will be some questions in the general essay. Most of the questions given in the general essay will be related to economics. So, generally this topic would help you, monetary policy transmission. Here, monetary policy transmission is the process which central bank follows with a change in policy instruments. Already we have seen policy instruments are getting changed according to the situation prevalent in the country. Impact the end objectives of stable inflation and sustained economic growth. So as because of change in policy rates, the end objective, your end objective is achieving price stability and economic growth. These objectives are getting affected. That is why I told that critics point out tight monetary policy will be very much difficult for Reserve Bank of India to achieve the balance between economic growth and price stability. So the end objectives are getting affected as because of change in the policy instruments. That is the monetary policy transmission. Here, the monetary policy transmission explains the channels through which Reserve Bank of India affect inflation, income, output and employment. Just income, output and employment, 3 factors you remember. So, monetary policy transmission explains the channels through which Reserve Bank of India affect. See, because of the usage of these policy instruments, income, output and employment will get affected. Next, This monetary policy transmission also helps the policy makers in order to expect the future inflation rates also. Here, there are 4 traditional channels through which Reserve Bank of India transmits policy action, transmit the policy action through 4 channels. It transmits the policy action. All policies you have seen that. Your objectives you have seen, policy instruments also you have studied, impact and everything you have studied. How Reserve Bank of India channelize all its channels, its policy, how the policy will be transmits its policy action to the real economy or interest rate. Just I will simplify, just to remember. For example, interest rate. Interest rate affect consumption and investment. Is it right or not? Interest rate affects consumption and investment. For example, at a lower rate of interest rate is reduced. Thereby, you can expect more consumption expenditure from farms and households. As an household, I will purchase more commodities at lower rate of interest. I will borrow money from the bank, thereby I will purchase more commodities. So, at a lower rate of interest, the expenditure of the farms and households will rise. At the same time, opportunity cost of savings will decrease. This is one channel, one effect also I told that. If you lower the rate of interest, if the rate of interest is low, the expenditure of the farms and households will be high. Why expenditure of the farms and households will be high? As the cost of borrowing is low. Cost of borrowing, you are borrowing at a lower cost, thereby you are spending more. Whenever you spend more, opportunity cost of savings will be less, it will decrease. Next, credit channel, credit. Here, the credit channel, it affects firm's balance sheet and its credit worthiness also. Both sides, as part of credit, if the credit creation is more, or otherwise if the credit creation gets affected, both the sides we have to observe here, but simply I told that the credit channel affects the firm's balance sheet and its credit worthiness. Asset price channel. For example, we have been adopting monetary policy since 1950-51. Monetary policy was in force since 1950-51. As because of change in monetary policy, the impact would be on the asset prices, Am I right or not? Asset prices will get changed. Will be the asset worth will be changed. You will find variation in the asset price as because of change in monetary policy. But in medium term, you will find a wealth effect also. Wealth effect means, so change in monetary policy will have an impact on the asset prices. But in the medium term, the wealth effect, there will be some wealth effect also. Because of that wealth effect, your consumption and investments also will get affected. Consumption and investments will get affected. Actually, because of that wealth effect, your consumption will be more. Whenever your consumption expenditure is more, generally aggregate demand will be high. Whenever the aggregate demand is rising, investors will invest more in the economy. Investors will invest more. There will be more investments. The next one, exchange rate channel. Exchange rate channel operates through inflation rate differential, interest rate differential. These two concepts you remember. Exchange rate channel. See, this is in a single sentence, just you remember how Reserve Bank of India transmits the policy action to the real economy. How the policy action will be transmitted to the real economy. So 4 channels we have taken here: interest rate channel, credit channel, third one is asset price channel, fourth one is exchange rate channel, exchange rate. So here the monetary policy, the exchange rate channel operates through a change in interest rate differential and inflation rate differential. These are the two important concepts. For example, how exchange rate will be determined. For example, how Indian currency value will be determined against a basket of currencies across the world. What factors would contribute for that? You know that already I told the flexible exchange rate system is in existence. Under flexible exchange rate system, under the system, exchange rate will be determined by market forces. That is okay. That is different. Now exchange rates are determined by market forces only, demand and supply. Reserve Bank doesn't have any role. Government also doesn't have any role. But I told RBI intervene in the public system, in the exchange rate market. So under managed floating system, the Reserve Bank of India will adjust the peg by a smaller amounts, very frequently, by a smaller amounts. It was in the civil service prelim exam, old paper you see after my class, crawling peg, long back, 10 to 15 years before it was given. As part of managed floating system, what kind of system RBI adapts? Crawling peg. It means the Reserve Bank of India will intervene in the forex market very frequently, and adjust the peg. It will adjust that peg by a smaller amounts, very frequently, to address further fluctuations in the currency value. To address further fluctuations, Reserve Bank intervene in the forex market very frequently and adjust the peg by a smaller amounts. For most of the period we have seen that. Okay, that is okay, but here you remember, this exchange rate channel operates through inflation rate differential and interest rate differential. Here you remember, if you follow expansionary policy, expansion. See, during this expansionary policy, if the monetary policy is expansionary in nature, the interest rate differential between the two countries will be low. The another country already you have taken, America. Rate of interest in America is at 4% only, not more than 4%. During COVID period, there was 0% of interest in America. Now slightly, America is also rising rate of interest. As a result, the American currency value is appreciating against most of the currencies across the world. That is the reason. As American Fed Reserve is raising rate of interest slowly they are raising rate of interest. Actually, foreign investors are investing heavily on American bonds and securities. Because see, foreign investors have more confidence over the American economic system. They are raising rate of interest. Thereby foreign investors are purchasing American bonds, American securities. America is attracting more foreign investments. Capital flow is more. They have more excess supply of foreign currency. As there was excess supply of foreign currency, their currency value will appreciate. Foreign currency value depreciate. So still now it is happening in America. American currency value is appreciating against a basket of selected currencies, number of currencies across the world. So here I told, as because of expansionary monetary policy, during this expansionary monetary policy, the interest rate differential will be low between the countries. It would lead to depreciation of Indian currency. So here simply just you have observed, there are 4 channels from which RBI transmits its policy action. This is the policy action. Now we say, but actually though it is the third part, this is very important topic actually. Transmission, monetary policy transmission. Question will be designed like this. Do you think that monetary policy transmission is weak in India? So justify this statement. We have to say monetary policy transmission is weak. We say like that. Because of these reasons. These are the reasons. So the transmission is weak, it means RBI changes the rate of interest. Now RBI reduced repo rate. Reduced. What commercial banks have to do? Commercial banks also have to reduce rate of interest on various advances given for various purposes, but banks will not react immediately. So that is one of the reasons for which we say monetary policy transmission is weak. Though Reserve Bank of India reduced the rate of interest, recently repo rate is reduced by 25 basis points, the other commercial banks will not respond quickly. So in India, monetary policy transmission has traditionally been weak for several reasons also, and dominance of public sector banks. Now public sector banks are playing a major role in India, but in the era of globalization we have allowed private sector banks also. But as far as the financial inclusion is concerned, public sector banks, as part of financial inclusion, public sector banks have set up their branches even in the remote areas, rural area, remote areas also. Thereby, the number of accounts with the public sector banks have been raised compared to the private banks. And at the same time, already I mentioned about direct benefit transfer during COVID-19 period. So for that, government uses only public sector banks only for direct benefit transfer schemes. So the public sector banks control a huge part of the banking system. These tend to less aggressive in changing their lending and deposit rates, partly due to the government ownership and other priorities beyond the profit. The next one, high non-performing assets, But you remember, but directly at present we cannot take this high non-performing assets as far as public sector banks are concerned. Non-performing asset means loans that could not be recovered. So in 2018, the NPAs of the public sector banks stood at 14%. Now at present, just 1 month before data, it is at 3% only, 3.14, nearly we can say 3.2% only of the aggregate loans, of the total aggregate loans. So NPAs of the commercial banks have been decreased. But you take the entire banking system, complete banking system. If you take the entire banking system, even last year also from economic survey, nearly 13 to 14% of the aggregate loans they have given. The total NPAs of the scheduled commercial banks, scheduled commercial banks, was at 13%, 14%, like that we have seen from the economic survey last year. So whenever banks are experiencing higher non-performing assets, it would be very difficult to lend money for various productive purposes. Thereby some of the productive activities are getting affected. Agriculture is a productive activity. At the same time, industrial activity is a productive activity. Some of the services. So you will find we have a number of productive activities. At the same time, small credit markets. Here you have to remember, India's bond market is not developed, underdeveloped. Just now I told that foreign investors are investing heavily on American bonds. As Fed Reserve is raising rate of interest slowly, they are investing heavily because investors have more confidence over the American economic system. But as far as India is concerned, our bond market is not well developed. At the same time, the small credit markets, administered interest rate, administered price is also one of the questions. In old papers you will find in other exams. What is administered price? Price that is not determined by market forces. It is determined by government authority. Telangana State Road Transport Corporation charges, price charged by Telangana Government State Road Transport Corporation is administered price. TSS PDCL Electricity Board, administered price, that is administered price. It was not determined by competitive forces, market forces, not on the basis of demand and supply. It is on the basis of public welfare. So by keeping in mind public welfare, government determines the price, that is administered price. Now you are paying more interest rate on some of the certificates such as PPF and NSC, National Savings Certificate, Public Provident Fund. So many small saving schemes have relatively high government set interest rate. Government set interest rate, that is administered price. If small savings of high returns, banks cannot cut a deposit rate immediately, which limit the ability of the banks to lend more money. On one hand, you are paying more interest on public provident fund and national savings certificates, but banks cannot, small savings offer high interest, high return, they are offering high return, but banks cannot cut the deposit rates easily, which limits their ability to cut the lending rate. Immediately they cannot cut the rate of interest. So it will limit the ability of providing more loans to various purposes. There are some liquidity issue also. When the RBI cuts the policy rates, liquidity in the banking system is not enough to allow the banks to lend freely. So liquidity issue. Even RBI cuts the policy rates, though RBI reduces the repo rate, but the liquidity in the banking system will not be enough to lend money for various purposes. And structural rigidities also. The lot of borrowers in India have fixed interest rate loans. For example, as far as housing is concerned, vehicle loan, banks lend, see, you have borrowed money from different commercial banks at fixed rate of interest, fixed rate. But on the other hand, you aim at keeping the inflation rate within a specific range, So in order to keep the inflation within a specific range, you are determining the policy rates. But on the other hand, already banks provided loans at a fixed rate of interest, which are not immediately affected by rate cuts. And weak monetary fiscal policy coordination. Actually, this is very important. Everywhere you remember, whatever the questions that are given in the civil service so far, this monetary policy, fiscal policy coordination also, see, everywhere at the end you have to interpret the importance of coordination, because monetary policy alone doesn't help you to achieve the higher economic development. Fiscal policy alone doesn't help you to achieve the higher economic growth. There should be a coordination between monetary policy and fiscal policy. For example, if you take government debt. See, recently, from recent economic survey, you might have seen, it was in between 55 to 60% for central government alone. In between, you will find the data. Debt of the central government, 55 to 60% of GDP, you will find the data. But government has to achieve debt sustainability. Achieving debt sustainability is a part of fiscal policy. But see, to achieve debt sustainability as part of fiscal policy, monetary policy should coordinate with the fiscal policy by reducing the rate of interest. Like that, there should be a coordination between monetary policy and fiscal policy. But see, such kind of coordination also cannot be seen. At every time you will not find that coordination. That is why the monetary policy transmission was very weak in India. So now here, what RBI has done to strengthen the transmission mechanism, strengthen the transmission. Here I have given some points. I have given introduced the MCLR, marginal cost funds based interest rate. It is the minimum interest rate banks lend money. Minimum interest rates bank lend money. 2016 linked lending rates more closely to banks' cost of funds. It has tried to make the interest rate more flexible. In simple terms, we can say at the minimum rate of interest at which banks will lend money. Next, move to external benchmark rates. So it is also one of the steps taken up by RBI. Mandatory linkage of loans, that is housing, personal, MSME sector, to external benchmark. That benchmark was fixed at a repo rate, Now repo rate is at 6%, So at 6% of interest, the banks are required to lend to certain sectors of the economy, which were identified. And Operation Twist 2019-20, RBI bought long-term bonds and short-term bonds. RBI has purchased long-term bonds and short-term bonds to influence the yield curve and support the better monetary transmission. Because if RBI purchases more bonds, long-term bonds and short-term bonds, thereby there will be more liquidity available in the economy. So credit creation also takes place. Who creates credit? Who creates credit? Commercial banks create credit. Who control credit? RBI. Liquidity injection, long-term repo operations to flood banks with cheap money. So RBI inject money into the system. In the recent COVID period also we have seen, on one day RBI has announced 19,000 crores of amount will be injected into the banking system, and SDF and MSF carried our tightening interest rates. SDF means statutory deposit facility. So here RBI absorbs excess money from the banking sector, excess money available with the banking system. Marginal standing facility, you are aware of that. Overnight, in order to address overnight interest fluctuation, the RBI charges a penal rate of interest on money given to the money borrowed by the commercial banks. So RBI narrowed the gap between SDF and marginal standing facility. And communication strategy. RBI starts clear signaling so that markets and banks anticipate and respond faster. That is okay. Next, banking sector cleanup, pushing for quality asset review, mergers of public sector union. Recently you have seen some of the public sector banks have been merged with each other, merging. That also we are recommending. Banking experts recommend just you merge weak banks with a strong bank. Thereby the performance of the banking sector will improve. So merger of PSU banks, recently we have seen that, and better NPA management. Just now I told that in 2018 NPAs of the public sector banks stood at 14%. By 2024 December it has come down to 3%, nearly approximately 3.2%. So these are the steps taken up by Government of India in order to address the weakness in the transmission. What is the time? This one already we have seen, that inflation targeting. Limitations already I have explained. So here, see further rate cut. Sometimes people expect every time. See, whenever Monetary Policy Committee meets, before Monetary Policy Committee meeting is convened, people expect that there would be some cut in the repo rate, like that people will expect. Recently 25 basic points have been, there was a 25 basic point cut in the repo rate. So the further rate cut depends on how growth inflation dynamics play out. How growth inflation dynamics play out. Based on that only, because I told that, see, if inflation rises, at higher inflation, the policy rates also will be hiked. So it all depends upon these two growth inflation dynamics. Despite the limitations I told that, still you are using consumer price index combined to construct a consumer price index combined. You are taking 2011-12 as the base year. Though it was revised in 2015, still there are some unnecessary commodities which are included in the basket of consumer price index combined. Like that I told, it may not be that much of effective due to structural constraint. See, though India is progressing like that in different fields you have observed, still India is experiencing structural constraint. For example, there was one question in already groups exam. What kind of unemployment prevailed in India? Structural unemployment, structural. Why structural? The economic structure itself remained backward. India's structure itself remained backward. There was low productivity in all sectors of the economy. There was low capital formation, low investments. So structural constraints are there in India, and supply shocks are there. That is why the inflation targeting may not be that much of effective. So, despite the limitations, inflation targeting can become an effective tool for achieving macroeconomic stability, but its implementation requires a careful consideration of its benefits and limitations in the context of Indian economy. Though there are certain limitations, that inflation targeting, there is a possibility for achieving the inflation targeting. For that, a careful consideration of its benefits and limitations in the context of Indian economy, and there is a need to strengthen monetary policy transmission. Just now you have seen that weak transmission mechanism you have observed, it should be strengthened, and enhancing coordination between monetary and fiscal policy. Don't forget about this one. It is a long answer question. How do you achieve coordination between monetary policy, fiscal policy? Long answer question. Simply in one sentence, just I told that. During the recession, government has to enhance its spending. Recently, the World Development Report, that report also highlighted public investment on education and health. And not only education and health, infrastructure, everywhere. Government should come forward to invest more. Because you have observed, American economy is a capitalistic economy. But after American crisis, during that crisis, Paul Krugman, Nobel laureate in economics, American-based economist, actually he has forecasted American crisis. Just 1 year before, he has forecasted America is going to get into recession in the next 1 year. He has forecasted that. He is a Keynesian follower. He himself told, role of the government is very limited in America, but government should come forward to invest on infrastructure. Not only infrastructure, you spend more. Government should intervene in economic activity, because government role is very, very much confined to some activities in capitalistic countries. So there should be more government intervention in activities, in economic activities, like that he only told. Recent world reports also, there are different reports published by various world organizations across the world. In some of the reports have highlighted the importance of stepping up of public investment, There should be more government investment. So, during the recession, government should spend more and lower the taxes. You have adapt expansionary fiscal policy during the recession, and to combat inflation, government might reduce the spending. Just you can reduce the spending. Generally, during inflation time, government reduces its expenditure. During deflation time, during recession, government will raise its expenditure. So, government might reduce spending and raises taxes. It has to follow contractionary policy whenever to combat inflation, to address inflation. To address inflation, you follow contractionary fiscal policy, and the central bank, that is like Reserve Bank of India, is required to raise the rate of interest to check inflation. Okay. With this, I stop my presentation. I thank Professor Ganesh Garu for giving me the opportunity to deliver the lecture. I thank you all for attending this session. those who are preparing for civil service. As part of general essay, this topic is more important. And you will find some questions, say for example, whatever it may be. Just the content is limited. I have limited my content particularly with regard to this transmission mechanism. Inflation targeting, okay. Transmission mechanism also is very important. And at the beginning, money supply concepts are given. You people might have observed from some of the old papers also. M1, M3, L1, such kind of questions already given. And regarding CPI, WPI, CPI combined also already given. That is why I tried to cover for the benefit of the students appearing for the preliminary examinations also. Some slides I have covered like that. But only for civil service students that we need not teach that money supply concept.
Why? Reason. Plus or minus inflation.
That is why I told that there was a conflict. There was a conflict between different macroeconomic variables. Conflict is there. For example, on one hand you are saying achieving full employment on one hand. We have to achieve full employment on one hand. Thereby you are saying price stability. Both you are saying that. To achieve full employment, there is a need to enhance credit flow to into various sectors of the economy. Generally what would happen if commercial banks extends more credit to various sectors of